Welcome back. Interest rates have really gone up over the last 2 weeks. And what that's caused is that bond returns have also gone up because the returns on bonds go up with interest rates. And that makes the bond market more attractive to an investor. And an investor that is looking for income out of their portfolio, probably an older investor like myself, where in the next 5 to 10 years, you're looking for income out of your portfolio, and bonds could really serve that type of investor really, really well. Um, I I happen to think that bonds are a good investment. They hadn't been for 15, 20 years because interest rates are so low. But as I'll show in a little bit, they have gotten really good. So I'm investing in bonds, and I'd like to share my analysis with you. And I'd like to go over my investments, a couple of them that I've invested in. Do me a favor and like my video and subscribe to my channel if you like content like this. And please provide comments. Now let's talk more about bonds. So bonds are a way for you to invest a corporate bond in a company that you really like or think that they're really good business. But rather than buying the stock, which could go up and down, you buy the bond. And the bond is basically a loan that company is issuing out. Or in the case of the US government, it's the US government that's reaching out and borrowing money from the people who buy the bonds. And over the course of time, the issuer pays a coupon rate, and that's an interest payment. So it's a nice way of collecting income. The other difference between a bond and a stock, and it's a very big one, is volatility. Stocks, as they proved in 2022, can go down quite a lot. You look at Netflix, although they're doing really well in 2023, they went down more than 80% in 2022. You look at Meta, one of my biggest positions, they went down about 80% in 2022. So that type of volatility is just really crushing. And the older investor, you can't weather long periods of investing like that because you need your income. You need to live on your portfolio, and that's why bonds are beginning to take a bigger part of my capital outlay, so that I have both dividend paying stocks, but also really good bonds that are really generating income. And the bonds will have a more stable value because the other thing about a bond is at the end of the term, you get the particular par value. $1,000 tends to be the par value, and you get that par value back, as well as all the interest between the time you buy the bond and the time the bond expires. So that's a way of really limiting risk, as opposed to a stock. You can buy it today and you think it's going to go up, but it goes down, and it goes down for like 5 years, and it's hard to sell it because you'd be selling at a loss. During that time, if it's not a dividend paying stock, you're not going to get any income from that stock. So that's the reason for bonds, and that's the reason for bonds in my portfolio. So here's the 10-year interest rate treasury. And over the last, it looks like, call it 25 years. And about 22, 23 years ago, we had a pretty high interest rate. This was about the year 2000. And we were kind of in a normal interest rate level back in the day, up until about 2007, I guess. Then we had a very significant recession, the Great Recession, if you recall. And the Federal Reserve decided, hey, let's lower interest rates to stimulate the economy, because back then we had the Great Recession. That's when we had the big bailout on Wall Street of big banks and insurance companies. It was a really difficult period. So the U.S. government, the Federal Reserve, lowered interest rates, and they kept them low for a long time. If you look at the level that they kept them at, it was pretty low. And that really makes, if you look at the valuation of companies, you use a discount rate, and that discount rate is based on current interest rates. So having that low of an interest rate on the 10-year treasury caused stocks to be very favorable. And then we had COVID, and the Federal Reserve again just lowered interest rates very dramatically. I mean, we were down to less than 1% on the treasury. So it made bonds just uninvestable. There's no way anybody should have bought bonds at that level. And this is why, if you recall, Silicon Valley Bank got in trouble is they bought bonds, let's say around here, and then as interest rates go up, the value of that bond drops. And Silicon Valley Bank started to realize a lot of losses. So down here, bonds were uninvestable. Just, it was just such a bad investment. At this point, I had just about zero in bonds. And really during this time, bonds did not provide enough return for me to put money into bonds, even though I'm at an age where I should be, growing the part of my portfolio that's fixed income. So, but now, as you see this giant rise, it's become far more attractive. We're at like literally 5% on the 10-year treasury, and that makes corporate bonds even more attractive because they're going to be higher than that. And as well as, those would be AAA corporate bonds would be at 5.5. But if you go to maybe double B, which is a less of a grade but more risk, you can get 7 to 10% interest on bonds. I go internationally and I invest in a bond with Pemex, and I make almost 12% on that bond. So bonds have become really attractive. And again, they have that consistent income, aspect to them. So that's also an attractive, reason to have them in my portfolio. Higher interest rates really do affect stock prices as well. I've got the same chart I was just showing here, just a little bit smaller so I can fit the returns of the S&P over the last 20 years. And if you look at this high period of interest rates, that's around this period of time. So you can see that the stock market had trouble in 2000, 2001, 2002. And ever since then, we had these low interest rates, especially this year. You look at, very good returns with very low interest rates because the discount rate that you use on a stock to value it is far lower during a low interest rate environment. So there's a couple of reasons to consider bonds, especially if you're older like myself, is A, consistent income, less volatility. You're going to get that par value back at the end of the term. And right now with higher interest rates, there's a good chance that the stock market is going to struggle as it has in the past when you had high interest rates. So I wanted to show three different bonds that I have. One of them is going to be short term, medium term, and then long term. First one is with Microsoft, very high quality bond. This one, the term ends on February 12th, 2025. It's about a year, call it a year and 4 months before they return that $1,000 par value back to me. And in the interim, they're going to pay me 5.3% as an interest amount, which is very good. I like that. And it's going to be in the form of a coupon rate. So it's going to come in, and I like that. I also invest in the ETF by Vanguard. And I know that there's other ETFs. This is the ETF that I invest in. I had some good comments on a bond video that I had before. So I appreciate that. Keep the comments coming on ideas of ETFs that are really good for bonds. But this bond ETF, which is a short-term ETF, pays 5.25. So a really attractive yield. Looking more mid-range bonds, this is Citigroup. They issue out a bond that's going to redeem on the 25th of July in 2028. So that'll be, call it close to 5 years. And at that point, they'll return all the par value of the bonds. But between now and then, they'll pay 6.7%, which is a very good yield. And an ETF will pay 5.35%, looking at the Vanguard ETF. And the last example will be a long-term bond. And these, especially if you really want to have the income, really determined for the next 10 years, this would be a good idea. And I'm not opposed to that. I think if I can lock in 5% on part of my portfolio, I'm a buyer of that scenario. So I bought into Johnson and Johnson. This is a AAA corporate bond. This is as good as it gets, and they're going to pay 5.08%, and this bond will redeem in basically less than 10 years, about 9.5 years from now. So that is a corporate bond from Johnson and Johnson. The ETF actually pays a really nice rate of 5.81% if you look at the Vanguard ETF, which is an ETF that I am buying into. My goals with the bond portfolio is to diversify into bonds. Now that interest rates are higher and bonds are investable, because they weren't, like, geez, 2-3 years ago, it was like, stay away. It was just bad news. But now that they're very attractive, and you can lock in a 5% or more return, it's become a really important piece to my overall portfolio, especially as I head toward retirement. So bonds give me nice diversification away from stocks. Stocks will continue to be the primary investment vehicle for the next 5 years. But over the long haul, I think bonds will continue to be a bigger portion, especially if interest rates continue to go up or stay high. I'm looking for these bonds to pay me 5 to 9% return. In some cases, even higher than 9%. I have one individual bond that pays 12%, which is really attractive. And I think the risk on that bond is reasonable. So really good return from bonds. That's going to be consistent. And the cash flow. I think the income that bonds will pay is something that's going to be important as I head toward retirement. And I need a consistent flow of income so that I could pay for my living expenses. So that's my video on bonds. I hope you found it interesting. Do me a favor and like my video and provide comments. I'd really appreciate that. And good luck investing in 2023.